form I did post in Canvas, but anybody else? Over here. That it? Everybody? Okay. So we had been talking about, let's just kind of review where we are at. We've been talking about purchases, and now we're talking about selling. So we buy goods to put them on our shelves and resell them to our customers. So we did all the transactions associated with buying those goods and getting them ready to sell. And then on Friday, we started looking at the transactions that were necessary to actually sell goods inventory to our customers. So we had a couple of new accounts. We'll just review those real quick that we need for sales. And then we'll get back to our PowerPoints here. So we had sales, which is going to be the account that we use when we record our revenues, right? This is our revenue account. We had cost of goods sold. If you were not here on Friday, you should watch the lecture because it talked a lot about the connection of cost of goods sold to merchandise inventory, right? What kind of account is cost of goods sold? It's our largest expense. It's the only expense account that doesn't have the word expense in it. But cost and expense really mean the same thing, okay? And then I think we kind of wrapped up with these two accounts, sales discounts and sales returns and allowances, yes? Took notes, and you go back and look at your notes because I know it's been 3 days. What kind of accounts are these?
Contra revenue.
Contra revenue, yeah. And so we talked a little bit about the significance of those two accounts because they help us to calculate what we call net sales. So we start off with some sales number, we subtract out our sales discounts. Let me move this over here, I guess. And we subtract out our sales returns and allowances. And that gives us what? Net sales, yeah. So the word net means I took two numbers and I subtracted, at least two numbers and subtracted. So basically, what we talked about is my sales represents the gross amount, the total that I charge to my customer. But we talked about the fact we give customers 30 days to pay. We'd like them to pay sooner. We want our money sooner. And so we incentivize them to pay sooner by offering them a discount if they pay within 10 days. We were offered that same discount, right, by our supplier. So it works both ways, accounts payable and accounts receivable. The sales return and allowance, that just means that people return things. So I might have sold something, but then they brought it back to my store, right? And then I think we kind of wrapped up by me asking you all, why do I care? Why do I keep track of these things separately? I mean, I could technically just reduce my sales. And I'll explain more about that when we look at an actual example because we're going to do one. Why do you think I keep track of those two things in separate accounts? And I just don't go because, look, this is my sales account, right? And we know revenues have signs like this. So anytime I record a sale, this goes up, right? Well, if somebody returns something to me, why don't I just debit sales to reduce sales? Well, the answer is because the returns and the discounts get lost in this account, and I don't know what's what. So I keep track of the discounts and the returns and allowances separately. So my sales discounts, if it's a contra account, in other words, it works against my revenue, the signs are going to be this. You can kind of think like of discounts and returns as an expense because they work the same way. Don't expenses reduce revenues? Yeah. Discounts and returns and allowances also reduce revenues, but they reduce specifically sales. And so we call them contra revenues because they go directly against sales. They're not like general expenses, right? And then sales returns and allowances, which I'm going to abbreviate sales R&A for now. It works the same way. See, they're contra accounts, so they have the opposite normal balance that sales have, which is why we subtract them. See, less, not add, less. Okay? I want to keep track of my discounts. Are my customers actually taking advantage of that incentive that I'm offering? I really want to keep track of my returns. You know, do I have a customer that's constantly returning things? Or asking for, you know, some kind of reduction on price? Is there something funny going on with returns? You know, so keeping track of these items in separate accounts rather than just directly reducing sales allows me to track those things better. That is why I do them. So as I mentioned the other day, we have discounts that we offer to our customers, and it's going to work the same way. Just like our suppliers gave us 30 days to pay, and then maybe 10 days if we paid early, we got a discount. We're going to do the same thing for our customers. We're going to extend credit terms to them. We're going to give them 30 days to pay. If they pay within the discount period, we'll give them a reduction of the original selling price. So what we need to look at now are some examples, and then we'll do our own. Now, before we do that, I'm going to come back to this form, right? And it's two-sided, but what side do we start with first? And you might want to put a 1 in the upper right-hand corner of that. I think that would be a fabulous idea. We start with purchases. Somebody explain why. Nobody can tell me? Nobody can tell me why? I got to buy the goods before I can sell the goods, right? What are the goods? Whatever you want them to be. Whatever you'd like to sell in your store, right? For me, it's probably, I always use shoes as an example. I got to buy shoes from shoe manufacturers to put on the shelves before I can sell anything. And so, excuse me, this merchandise inventory account was the main account that we used to record the purchases of those goods. What kind of account is this? It's an asset, right? You guys got a quiz coming up this week. I didn't post it yet. I wanted to wait till we got done today. But just that normal quiz that I was giving you each chapter. I didn't give you one for chapter 3, I don't think, but terminology, a lot of new terms in this chapter. So I want to make sure that you're studying those terms and you understand what these words mean. So we assume that before I do any selling, there is a dollar amount. And there's all kinds of activity in here, right? We talked about the different things that take place in here. But this amount here, this represents the available amount of inventory that I have to turn around and sell. There's got to be something in here before I can go to my sales transactions. So this particular side of the paper, this has to come first, right? You got to buy first, and then on the back side are my sales transactions. And they're the opposite, aren't they? They're the opposite. So if I buy something from you, you're selling it to me. I'm the buyer, you're the seller, right? That's how it works. Okay? So we've got some journal entries here. And again, if you have this paper, then you're not flipping through all kinds of PowerPoints or textbooks or whatever. I kind of just organized all the purchase transactions on one side, all of the sales transactions on one side. So we're going to come back to this after we look at the example that is provided in the PowerPoint, and then we'll practice one ourselves. So we're going to head into, we don't spend too much more time in this chapter. We'll head into chapter 5 later in the week, so we kind of move along. Again, we're not learning anything new in terms of the accounting cycle, just applying the cycle to a different kind of business. So these are all just the day-to-day activities. So this would be just like step 1, right? Record economic events and transactions. We would go through the same 10-step process with our retail store as we did with our service business. I wish I had time to go through the entire cycle in every chapter, but we don't. So we just kind of have to try to make those connections as best we can. All right, so Z-Mart completes a $1,000 credit sale with terms of 210 net 45. So a credit sale means that Z-Mart did not get cash today. Credit terms mean that they're giving their customer how many days to pay total? 45. And they're incentivizing them to pay early. How early? 10 days by offering them what kind of discount? Yep, so 2% discount if paid within 10 days. Otherwise, the net due is in 45 days, right? Net due is in, yeah. Okay, so on November the 12th, remember the other day I said, when you sell something, you have 2 journal entries. This should be in your notes. 1, to record the revenue. The revenue is what you charge your customer. So it's a debit to accounts receivable and a credit to sales. It says for $1,000. That's what they charge the customer, right? What you sold the customer was something in here. Yes? Okay? So you need a second journal entry to remove that item from your inventory. You no longer have it if you sold it, so you no longer have this amount of inventory. When you sell inventory, what does it become? An expense. Which expense? Cost of goods sold. Yep. So remember I wrote that on the board on Friday? Kind of showed you the similarities between supplies and insurance and inventory. You buy it, it's an asset, but once the benefit's gone, then it becomes an expense to you. You no longer have it. I used it to make money. That's the definition of an expense. So once it's in your possession, I got to take it out of my inventory and I have to record my expense, my cost. So in the next journal entry, there's a debit to cost of goods sold and a credit to merchandise inventory for $300. Tell me in easy terms what the $300 is in relationship to what you just sold. What I paid. Yeah, so if I sold a bunch of shoes for $1,000, I paid $300 for those shoes. That's my cost. How much money did I make? My gross profit, right? Remember the calculation for gross profit? So now we go back to our income statement. And our income statement gets a little bit more complicated. And we had sales, I'm going to rewrite this again, less sales discounts if we have them. Not every transaction results in discounts or returns, but they could be zero. In any case, we have the net sales. My net sales less my cost of goods sold is my gross profit, right? And then I subtract, who remembers what comes next before I get to net income? What do I still have to subtract? This is only one expense. It's my largest expense. What other expenses do I have? I got all my other operating expenses. So I'm going to subtract out my operating expenses, and that brings me down to net income. So ultimately, all of these transactions that we're recording that are associated with sales are going to be used to going to be used to do our income statement, okay? All right, now, in this particular example, there are no returns. The customer didn't return anything, but we did give the customer an incentive to pay early, and it looks like you got what happens either way. So the first one here, the customer does pay within the discount period. So this was the 12th. Remember I said stretch that to the last day, right? Keep your money for as long as you can. If you're the customer, don't pay your bill till it's due. You can still take advantage of the discount on November the 22nd, right? That's the last day to take advantage. So here's what I want you to kind of pay attention to. I don't have T accounts up here right now. This account receivable, you expect to receive $1,000 or a little less if your customer's taking the discount from your customer. So you expect to receive cash. That customer expects you to apply that payment to their bill, which is the account receivable. Okay? So here, you'll notice a debit to cash, but you're not getting $1,000 because your customer's paying in 10 days. You told them they could take a 2% discount. 2% of 1,000 is $20. So that means they're only going to pay 98% or $980. That's how much cash you're receiving. Here's what I want you guys to look at. Look, the debit to sales discount for $20. That's this account here. Theoretically, I could go and just debit sales to reduce sales, but I want to keep track of those discounts separately. I want to keep track of those returns separately. So I'm going to debit sales discounts for 20. Notice that we credit accounts receivable for $1,000. We clear out the receivable for the full amount. The customer is satisfying their balance in full, right? We're not getting the exact amount of cash because we said they could take the discount. So this is what this looks like up here. I want you guys to look up here real quick, and then I'll come back to this. But just with what we have up here, right? My sales were $1,000. I had a discount of 20. I didn't have any returns, so my net sales are $980. The cost of goods sold was $300. And so my gross profit is 680. And the gross profit then, and I don't have any more information to fill the rest of this out, but you guys hopefully get the idea. This then would be used to cover operating expenses, and then whatever's left over is my income, right? So that's how this all works. But could I have just gone right up here? If I would have just directly reduced sales, this would have just said 980. I wouldn't have known what that number consists of. I get all the detail when I keep track of those three things separately. If this customer did not pay within the discount period, the journal entry is a little simpler. After the discount period, they gotta pay the whole $1,000. So it's just a debit to cash that you're receiving, and you're clearing out the customer account for $1,000. If you look at the handout that I gave you, okay, the first journal entry, and you guys, you have to read. That's some of you, part of your issue is you don't want to read. To record the sale of merchandise inventory to a customer. Here's your two entries. The first one to record the revenue. The second one to record your expense. So that comes first. Now, we haven't had an example where we had a return, but if we had a return, and we're going to do that next, we'll come back to this one. Here is if you receive payment within the discount period, a debit to cash, a debit to sales discounts, a credit to accounts receivable. If payment is received after the discount period. What you have to be able to decide in the transactions, and not until we do a problem that has both buyer and seller, is are you the buyer or are you the seller? You have to tell yourself or identify to yourself which one you are so that you know which side of this paper to be on, right? That's going to be the key to figuring all this out. Any questions so far? Okay, so back to sales returns and allowances so we can look at an example, and then we're going to do a couple exercises so we can practice, and then you're going to do some exercises together to practice. All right, so as I mentioned, a sales return. We've all done it. I'm assuming that everyone has returned something they have purchased in their life, right? You get it home, you either don't like it, you have buyer's remorse, it doesn't look as nice as it did in the store, whatever the reason, you take it back, right? So we have to obviously make adjustments for the sales, which is reduced by the return. Allowances, maybe it's got a little defect, you'd like to keep it, but you don't want to pay full price. That's a reduction in the selling price. So we have a couple of examples to sort that out. This one, customer returns merchandise which sold for $15 and cost $9. Okay, so just like, if you look at the handout I gave you, this is the second group of transactions. Just like when you sold it, you had two entries, right? When you sell something, you have two entries. You all agree? One to record your revenue, one to record your expense. So when somebody returns the goods to you, you're going to have two entries. Okay, so the first is to identify that it was a return, and it's going to reduce the original sales amount that you had. So it's a debit to sales returns allowances, and hey, people they just want their money back. They paid for it already. If they didn't pay for it, this would be a reduction to the account receivable. We'll have to look at that example, okay? If the goods are not defective, in other words, you just didn't like it, so what am I gonna do with it when you return it to me? Let's say you return something to me that costs $15, I give you your $15 cash, nothing wrong with it, you just didn't like it when you got it home, what am I gonna do with it? Put it right back on my shelf and try to sell it. So what I have to do is now it's my inventory again, I got it back. So I have to add it back to the merchandise inventory, so I debit merchandise inventory for what I paid for it, in this case $9, and I remove it from the cost of goods sold account because it's no longer sold. It was sold, but now it's not, so I gotta take it out of there. So I credit cost of goods sold to reduce it, because now I'm gonna try to sell it again. That's if the goods are not defective. If the goods are defective, there's a couple other transactions. I'm not gonna have you guys do them right now, but there are a few different ways to handle it. You may be able to sell them for a price less than what you paid, in which case you have a loss. Like if I paid $8 for some, or $9 for something, and now it's only worth $2, well, I lost $7 on that, right? Because it's something wrong that's defective. So this is if they're defective. We have an account called loss from defective merchandise, but you guys aren't gonna have to worry about that for right now. Just returning goods that are not defective, okay? An allowance is similar to a return, so we kind of lump them together. This is just an example. Assume that $40 of the merchandise Z-Mart sold on November the 12th is defective, but the buyer decides to keep it because Z-Mart offers a $10 price reduction. So listen, the customer called me up and said, I like this, it's got a little defect, can you just reduce the price? And I say, sure. So I am gonna debit sales returns allowances because I am not getting the full selling price. I'm gonna give them back whatever cash they asked for, but I don't do the second entry, which would be to add it back to my merchandise inventory because they didn't give it back to me, they kept it. I'm not trying to resell it, I just accepted a lower price for it. All right, so enough talking. Let's start doing here. So if I was you, I'd have this little handout handy. Does everybody have this? Buyer, seller. And we're gonna head to our end of chapter. Just gonna do a couple, I'm gonna do one with you, and then I'm gonna have you do one on your own here. So I'm looking at them on page 172. And this is another time where I'll tell you, please use T accounts, please, please, please. All right, quick study 4-8 on page 172. Oh, you guys should have a calculator too. Um, 72 or 172, I'm sorry. All right, so it says prepare journal entries to record each of the following sales transactions. So right there is your first clue that you want the selling side of the paper that I gave you. That's a good place to start, right? Okay. It says the company uses a perpetual inventory system and the gross method. So we talked a little bit about what that doesn't really impact anything you're going to do moving forward. Just means that you understand the perpetual inventory system means that I can scan an item and I can know how many I have on the shelf. Because that's what my fancy system tells me, right? Perpetual means anytime I want to know. There's an ongoing updated record of it. The gross method just means that I'm recording everything at the full amount, taking the discount later on. Okay? So notice that I have the 8th scratched out there because it doesn't really have anything to do with the 1st, the 4th, and the 11th, and I just want to focus on one transaction for now. So April the 1st sold merchandise with for $3,000 with credit terms net 30. So tell me what that means. No discount and they got to pay in 30 days. Not everybody is going to offer a discount. You pretty much do whatever you want, but in this case, no discount. The invoice is dated April 1st. The cost of the merchandise is $1,800. So someone, preferably by raising your hand, tell me what the first journal entry is that I need to record. Or I'll just start calling out, maybe I'll just call out people's names. Okay. It would be a debit to accounts receivable and a credit to sales for $3,000. And I'm going to actually make an account receivable T account too. Accounts receivable is what kind of an account? Okay, so accounts receivable and sales. All right, that's the first entry. What about the second one?
Would be cost of goods sold, 1,800, and then for 1,800.
Okay, so it would be nice if I wrote the word sales, huh? In my journal entry. Cost of goods sold, 1,800. Credit to merchandise inventory for 1,800. I was gonna say that looked weird. All right, cost of goods sold 1,800. Now, we know that cost of goods sold is an expense, and expenses have normal balance of debits. I do not have the merchandise inventory account up here. Maybe I should, but what assumption do I make about that account? I already asked this question earlier. What assumption do I make about that account? Because I'm crediting merchandise inventory. Merchandise inventory is an asset, and a credit reduces the account. So what do I have to assume? What happened before I sell? I had to buy. So I have to assume that there was already a balance in merchandise inventory, and then I'm just pulling from that available balance of inventory, right? I have to assume that the buying came first. Okay? All right, we good with this transaction? All right, now it is April the 4th. The customer in the April 1st sale returned $300 of merchandise for full credit. The merchandise, which had a cost of $180, is returned to inventory. So no defects. What do we got to do here? Who wants to give me the journal entry? Go ahead, Paul.
Get the debit sales returns and allowances.
Okay, I'm going to debit sales returns and allowances for how much?
300.
Yep, okay, and what am I crediting?
Accounts receivable.
Accounts receivable for 300, and then?
Debit merchandise inventory and credit cost of goods sold.
I'm going to debit merchandise inventory for 180, credit cost of goods sold for 180, because now I'm going to add it back to my inventory, right? And let me do this here. What I made an assumption that there was an available balance in this account, right? I credited merchandise inventory for 1,800 originally. Now I'm putting it back for 180. Cost of goods sold, I'm reducing also by 180. Sales returns and allowances, where's my sales? Here we go, gets debited for 300. AR gets credited for 300. All right, now, oops, sorry. The 11th, we receive payment. I write too big, I think. Oh, let me just come over here. I can squeeze it in down here. We receive payment. But here's what I need you guys to pay attention to. Look up here. Who are we receiving payment from? Which account? Just going to get the payment applied to it. Yeah, the account receivable is my customer, right? How much does my customer owe me? Okay, they owe me $2,700, don't they? Why is it less than $3,000? Because they returned something. You don't want to pay for things you've returned, do you? Neither does your customer. All right, now, did we offer them a discount? No, so how much are they paying us? So what are we debiting? So if you look at your paper, there's a journal entry there at the end, at the bottom, right? That says to record the receipt of payment with no discount. Yes, a debit to cash for $2,700 and a credit to accounts receivable, because the customer wants you to apply their payment to their account, and when you do that, their account reflects that their balance is 0. Now we need one that's a little more complicated than that, I think. Don't you guys think so? No? No one's going to say, okay. Let's do this. Page 176. This is one of my favorite things to do. I'm easily amused, apparently. Page 176, exercise 410. We're going to do a little bit of both, buying and selling. And I'm going to do one of my favorite things, just like I did at the beginning of this chapter, is a side-by-side comparison. in the parentheses there, it says what? Buyer. And Troy Wholesalers, in parentheses, it says what? Seller, sorry. Enter into the following transactions. Both Sydney and Troy use perpetual inventory system in the growth method. So we only have 3 journal entries. This is why I like this one. And we'll come back to those, but it says prepare journal entries that Sydney Retailing buyer records. Prepare the journal entries that Troy Wholesalers, the seller, records. So we're going to go through each one of these. We'll do the buyer first, then we'll do the seller. Okay? So I'm going to do them side by side though, because at least I think it's helpful to see like from both perspectives, because the journal entries are exactly the opposite, as you'll see. Okay, so we've got Sydney, buyer. And we've got, down here, we've got Troy, seller. Now, I don't know if this is possible for you guys to do this in your notebook like this. It's not a big deal if you can't, but I'm going to do it this way. May 11th. So which side of your paper do we need to look at first? We want to do the buying first, yeah. Right, so we'll do that. So Sydney accepts delivery of $40,000 of merchandise. It purchases just another word for buy, right? It purchases from, for resale. In other words, Sydney's buying this stuff to turn around and sell it, right? Eventually, from Troy, okay? Invoice dated May 11th, terms 310 net 90, FOB shipping point. Oh, okay. What's that mean? Who pays for the shipping? FOB shipping point, who pays? It's not written on me, look in your notes. Answers are not on me, that's why you have notes. Talk about it Friday. Nope. It's gonna be the buyer, yeah. Buyer, right? Okay. The goods cost Troy $30,000. We're not recording Troy yet though, right? We're doing Sydney first. Sydney pays $345 cash to express shipping for delivery charges on the merchandise. So I have 2 entries here, all right? Let's do the first one. The first one is to record the purchase of merchandise inventory. So what do I debit, what do I credit for Sydney? Okay, I'm going to debit merchandise inventory. And how much inventory? What's the amount? Okay, what am I going to credit? Accounts payable. Yep. Now, I know you're all don't like to do T accounts, but too bad. Well, I can't make you do T accounts, but I'm going to use them up here. I'm going to abbreviate for the sake of time. And we got 40,000 and 40,000. All right, what about the shipping? You already told me that the buyer is responsible. They own the goods. So looking at your paper that I gave you, probably the very last transaction on that front side, what does it say? To record the payment of freight charges, right? Yes? Yes. So what do I debit? Yeah, so remember, if I have to pay for shipping, I get to add the value of that to my merchandise inventory. So I'm going to debit merchandise inventory. This is another transaction on the same date because I got to pay for shipping. How much was the shipping? $345. And what am I crediting here? Cash. Because it's a separate payment. It's a separate bill. But I'm going to come over here and I'm going to add $345 to the value of my merchandise inventory. Okay, we're just doing Sydney. The rest of that has to deal with Troy. We'll handle that later when we go to do the selling, that does sound nice. On the 12th, Sydney returns $1,400 of the $40,000 of goods to Troy, who receives them the same day and restores them to inventory. the return goods had cost to Troy of $1,050. Now, we're not doing Troy right now. We're just doing Sydney, the buyer. So, again, looking at the paper that I gave you. Everyone should be looking at the paper and not doing anything else. Sydney returns $1,400 of the goods. So what do I debit and what do I credit for the buyer? Accounts payable debit, merchandise inventory credit. Okay, perfect. Accounts payable, 1,400, and merchandise inventory credit. Because if you're returning something, you want your bill to go down. That's the $1,400 debit to accounts payable. And obviously, you don't have that amount of inventory, so you got to credit your inventory. And then on the 20th, okay, Sydney pays Troy. Now, the discount was a what? What was the discount? 3% in the first 10 days. Are they within the 10 days? Okay. So looking at your handout. Okay, you're going to make a payment within the discount period. What are you going to debit? Okay, let's talk about just the accounts first. We'll debit accounts payable, then what? We're going to credit merchandise inventory, and we're going to credit cash. All right, now let's go back and fill everything in. Well, what do I owe? I returned $1,400. My bill was $40,000. Then I returned $1,400. So the total amount of my accounts payable that I should be paying is $38,600. Okay. Do I get to clear this whole thing out even though I'm taking a discount? I do. I get to clear that out. I'm paying my bill in full, $38,600. Okay. Is my cash going to match that? It's not. But that's not the point. The point is, I'm satisfying my liability or my obligation in full, okay? The credit to merchandise inventory. What am I crediting to that account specifically? The discount, very good, the discount. So I'm getting a discount on how much? No, that's the discount. How much am I getting, what am I getting a discount on? The $38,600. I don't get a discount on what I didn't keep. I returned $1,400. So $38,600 is what I owe. I only get a 3% discount on that. 3% of that is what? Okay, I meant to give me the amount of the discount, which is $11.58. Yeah. So let me make sure that everybody knows how we get these numbers. So I'm going to put that in parentheses. 38,600 times 3% is 1,158. Correct? Yes. Therefore, the amount of cash that I'm going to pay, $38,600, I'm going to do it this way, times 97%, right? Because if I get a 3% discount, I'm only paying 97% of the purchase price. And 97% of $38,600, as someone said, is $37,442. And what has to equal here? Debits have to equal credits all the time. Do my credits add up to my one debit? Yes. They do. So 1158, right? I already cleared out accounts payable. I don't have cash up here because it's kind of pointless. This balance right here, somebody tell me what that is. I want to talk about that just briefly. I don't know what I just did. That does not look right. Okay. Fingers aren't working for me too well here for some reason. Okay, there we go. All right, what do you got? 37,787. Okay. And what is this supposed to equal? Who remembers? I wrote this on the board several times when we were talking about purchases. A little bit more specific than that. No one wrote it down. I wrote it next to that account number, that number a couple of times, what that's supposed to equal. Nobody knows? I said you can't value your merchandise inventory at a number greater than what you what? Oh, people, you're killing me. Than the cash paid. Okay? So, any questions about that? You should. 37,787. What's this number? Okay, what am I missing? The shipping. Those were two separate transactions, but 37,442, right? Plus 345, does that equal 37,787? No? Did you say no?
Yes.
Okay. See, we had two separate transactions, right, for the merchandise inventory, so just FYI. All right, so now you guys got like 6 minutes. I'm going to give you a few minutes. You do the seller transactions. Flip your paper over that I gave you. And now you want to focus just on who? Because we're done with Sydney. Who are you doing the journal entries for? Troy. You guys can work together. You only have 3 journal entries. Let me ask you a question. Should the amount of cash that Troy receives from you here on the 20th be equal to what we paid? Sydney paid Troy. How much cash should Troy be getting? Yeah, so when you receive a payment from your customer, remember, Sydney is Troy's customer. That should be the same. Okay? All right, so you're going to have more transactions over the seller because you've got 2 when you sell it, 2 when you return it, and then 1 within the discount period. These are not the easiest, but I'm going to give you guys the rest of the time to figure that out. We'll go over that first thing on Wednesday, and then we're going to wrap this chapter up. There will be a quiz. I will post a quiz. At some point today. I have a busy schedule today. I don't know exactly when. But it won't be due until Friday. I'll give you the rest of the week to do it. But we are going to move on to chapter 5. You guys can work together. Doing the journal entries for the seller. So you've got to flip your paper over now. Match them up. Yes.
Would shipping, from the seller's point of view, also, would it just be thrown in with accounts receivable?
Nope.
No.
That's a whole separate thing. The buyer paid separately for the shipping. There's no shipping at all for the seller. The only time the seller is going to do a journal entry for shipping is if they paid for shipping.
Oh, okay, so that's just.
Correct. Yeah, that's a whole separate thing. It's like
Okay.
Sydney paid for the freighter, like the freight person, whoever that might have been.
Okay, so that money doesn't even go to Troy?
Correct.
Okay.